Is looking at your financial statements like trying to read Chinese? And of course, we're assuming that you can't read Chinese, and so that's a bad thing. Then this is a great place for you to start, because in today's video, we're going to be going over the three main financial statements: the income statement, the balance sheet, and the cash flow statement. At the end of today's video, you're going to have a much better time understanding what these financial statements are so that you can understand the health of your business at any time. I'm James Masotti, and I'm the owner of Our Team Accounting. And on this channel, I am passionate about helping entrepreneurs achieve their business and personal goals through intentional financial planning. The first of the critical business documents that we're going to be talking about in today's video is your income statement. And if you've ever heard of a profit and loss or a P&L, then you've heard of the same thing. All three of these terms are interchangeable and refer to the same exact document, just different people calling them different things. So the income statement is kind of like the scoreboard for your business. We're going to be tracking your revenue, and that's like the points that you're scoring. You're going to be able to see, are your sales growing on a consistent basis, or are you experiencing trouble with your sales? This is also where we're going to track the points that the other team is scoring. And by that, we mean, what are your expenses? And expenses are not always a bad thing. There are a lot of expenses that are really good for helping to drive your business in a positive direction. And you may actually see your sales and your revenue increase the more you increase certain expenses. Lastly, we're going to be checking on who the winner of the game is. And that's basically your net operating income or your profit, and how much is going to be left over at the end of each financial period. That takes us to our next concept, which is we look at our income statement in different periods. So whether that's going to be monthly or annually, or sometimes you might look at it on a quarterly basis, you're always going to be looking at it over some particular period of time. Something that's important to understand about your income statement is that it can be viewed in at least two different ways. And those are on a cash or an accrual basis. Both of these are based on what is known as GAAP, or the generally accepted accounting principles. And these are the way that the US financial statements are prepared. And you have the option of doing it both ways. And really the difference between those is when you spend the cash versus when the expense itself is incurred. For a lot of small businesses, you're probably going to be operating on a cash basis, but there are a number of businesses and a lot of times where accrual will make sense. Now, generally speaking, when we're talking about our income statement, we kind of simplify things and we will say sales minus expenses equals profit. And while there's a little bit more complexity behind it than that, that's the general formula that you're going to experience. And I'd like to point out and kind of recognize that I am a profit first professional, as you can see by my choice of shirts that I'm wearing today. And there's an important distinction in how we like to think about this formula, and that is sales minus profit equals expenses. And while mathematically these things may seem to be the same, they are in fact psychologically very different. And the reason for that is we prioritize what we put first. And so from a profit first financial perspective, we like to want to prioritize our profit and then reverse engineer the amount of expenses that our business can sustain while being at the revenue levels that we're at to generate the profit that we want to see. So we start off with knowing what our sales are, and then we say, here's how much profit we want. Or even further, we can reverse engineer from the perspective of profit equals sales minus expenses. And we can prioritize first identifying how much profit we need and what kind of revenue we need to achieve to get there. And that will tell us how much expenses we can afford to have. While this may be aspirational, it's great as a tool to use when you're doing some long-range planning. And all of that can come from your income statement. So why is the income statement actually an important document? Well, we've already touched on part of it, which is the scoreboard aspect of things. This is the place where you're going to be able to tell whether you're achieving your goals or not. You're probably in business, you've got some sort of a sales target that you want to have, or you have an income or a profit target that you're wanting to hit. And this is the document that's going to let you know whether you are doing that or not. It's also going to help you be able to make better decisions. So when you're trying to decide if it's time to hire somebody, or if it's time to buy a particular piece of equipment, or if you can afford to attend a conference, or any of these number of other things, being able to look at your financial statements and look at what's been going on the past several months and identifying how much money that your business is generating in excess is going to be able to give you an indication of what kind of additional expenses you can take on and what the impact to your overall financial position would be based on those decisions. And probably the most technical reason that we're going to need to have a income statement is for the purpose of filing our taxes and getting any funding that we need. Generally speaking, our financial statements and the income statement is a critical document that the IRS is going to want to look at in order to determine how much we're going to need to pay in taxes. And if you're ever needing funding from a bank or a line of credit, or if you are ever going to get an commercial insurance policy, oftentimes they're going to want to see your income statement in order to understand the overall size and complexity of your business in terms of the amount of revenue that you're generating in, the amount of payroll that you have, and overall the profitability of your business is all going to determine the level of funding that you'll be able to receive, or the amount of taxes you're going to have to pay, or how much your insurance premiums may be. Let's run through a quick scenario that might better explain how to use your income statement. Let's say that you own a small landscaping business and you've worked really hard this particular month and you're really looking forward to getting to the end of the month and seeing all of that money sitting in your bank account. And at the end of the month, it's not there. And you scratch your head and you try to figure out, why was it not there? And what you're able to do is you're able to look at your expense line items and you're able to see that your gas expense was extra high this particular month. And as a result of seeing that your gas expense was really high, that's going to lead you to ask a question about, well, why was my gas more than it has historically been? And as a result, you might look also at your revenue. And this is where expense ratios can really come in handy. And so if we look at the percentage of our revenue that gas expense was, if we identify that it has gone up as a percentage, then what that might tell us is, for example, that we've done more revenue, but maybe we've actually lost some route density in how we get to our clients. So in a business like landscaping, having a lot of clients really close together can be optimal because we don't have to drive as far in order to generate a maximum amount of revenue. Whereas we could still potentially generate more revenue, but if we're constantly driving across town or we don't have efficient route planning in place, then our gas expenses may go up and really eat into that extra revenue that we've generated. So being able to track your expenses and look at them in comparison to your revenue, and then start to question your business processes is exactly why an income statement is super critical to not only keeping score, but also to helping inform your decisions on how your business may be running. Doing your company's accounting on your own can be overwhelming and time-consuming when you're trying to run your business at the same time. If you're interested in learning more information about our do-it-yourself and done-with-you group coaching programs, or if you're interested in taking your services to the next level with our fully outsourced accounting solutions, getting help with implementing Profit First, or even fractional CFO services, go ahead and scan the QR code on your screen or click the link in the description below to find out more about these programs and how we can help support you. The next financial document that we're going to be talking about today is the balance sheet. And the balance sheet is something that is always taken as a snapshot in time. So while we can look at this still over a period of months, it's important to understand that it's kind of like, what is the ending balance at the end of each month whenever you're taking a snapshot of that. So if you were to run it for your current financial period and just run a balance sheet, it's going to tell you kind of where you stand at that particular moment in time. Your balance sheet is going to show you your assets, which are the things that you own and things that people owe to you. So the obvious examples here are going to be things like cash. There are equipment that you might own, vehicles that you might own. This might include real estate that you own. And it also includes your accounts receivable, which is the money that people owe you if you have sent them an invoice and they have not yet paid. So this is still considered an asset, even though it may not always feel like a good thing for people to owe you money. If your business has inventory, then you're also going to be reflecting your inventory balances on your balance sheet as assets as well, because they're going to be able to be converted into revenue and therefore benefit your business. The next part of what you're going to find on your balance sheet is the liabilities, or things that you owe to other people. The most common things that you're going to see under liabilities are going to be things like credit cards and loan balances. You're also going to be able to see any taxes that you owe as you accumulate. If you have to pay sales taxes on a quarterly basis, as you generate income, you will set a tax liability on your balance sheet. If you have to pay quarterly income taxes, you can be accumulating a tax liability on your balance sheet. This is also where you're going to reflect any paid time off that may be accumulating that you have not yet paid to your employees, or any payroll that they're accumulating, or bonuses or commissions that need to be paid out at some point. And then this is also where you're going to show your accounts payable. So this is money that you're going to owe to your suppliers. So if you've got a relationship or an arrangement with your suppliers where they send you an invoice and you don't have to pay them for 15 or 30 or 45 days, then you would need to reflect that payable amount on your balance sheet as a liability that you will owe in the future. The third component to the balance sheet is your equity position. And this is basically made up of the amount of money that you as the owner have invested into the business, as well as the retained earnings that have not yet been distributed to the owners. And so your retained earnings is an accumulation of the net income off of your financial statement, which is basically showing the amount of money that could be paid out to owners, whether or not distributions have actually been triggered or not. There is also an accounting formula for representing the balance sheet, and that is assets equals liabilities minus owner's equity, which is the technical definition of it. This is one that hasn't always necessarily made sense to me, because as an owner, I tend to think about my equity position first and foremost. I also tend to think about the balance sheet as my equity being my assets minus my liabilities. And as somebody who is first and foremost a business owner rather than an accountant, this way of thinking just makes more sense to me. So why is this particular document important for us? The two things that are probably most important for business owners from a day-to-day perspective are their accounts receivable and their accounts payable. It's really important to keep a tab on the amount of money that other people owe you, and that's in check with the amount of money that you also owe to other people. Without having to always go and check your bank accounts, you in theory could look at your balance sheet, but your balance sheet's only going to show the amount of cash that you have available depending on the extent to which you've processed your transactions. That being said, the balance sheet can help you make decisions. If you were, for example, looking at your balance sheet over a longer period of time, you're going to be able to identify whether your overall cash position is improving or declining. You're going to be able to look at your accounts receivable or your accounts payable over time and see if the amount of money that people owe you is climbing, and whether that percentage is in check with your revenue change. If your revenue is staying flat, but people are starting to owe you more money, then that's potentially going to be a problem for your business. On the flip side, if the percentage of accounts receivable that you have is declining as a percentage of your revenue, that means that you're actually collecting money from your customers more quickly, and that's a really positive thing for improving cash flows and overall business health. The third and final reason, much in the same way that an income statement is going to be helpful for the banks and for investors, so is your balance sheet. This is going to give them a picture of, over a period of time, the amount of money that you've had to put in, the amount of money you've been able to pay out, and your ability to generate sustained earnings through the retained earnings amount on your balance sheet. It's going to let them look at your cash position to be able to see, like, hey, are you liquid enough in order to be able to handle the ups and downs that maybe come with your business and any seasonality that happens? And that would be able to be reflected by also looking at your income statement. If you have seasonality where your expenses maybe stay the same, but your revenue decreases, well, you're going to need to have cash available to absorb that when those months or periods of time come through your business. All right, let's go ahead and revisit our example of having a small landscaping business. Let's say you've just won a great new commercial account and you're really excited about the opportunity to expand your operations to be able to deliver on this increase in revenue. But before you decide to do that, you're going to go ahead and look at your balance sheet to see if you're going to be able to afford to service this great new win that you've just had. So you take a look at your balance sheet and you see that you've got $65,000 in assets. You've got $10,000 in cash sitting in your bank accounts. You've got $50,000 in equipment spread out between mowers and trucks and trailers. And then you've got $5,000 sitting in your accounts receivable from money that clients still owe you for work that you've completed, but they have not yet paid on. You're then going to take a look at your liabilities and you're going to see that you have $30,000 left on the loans for your vehicles and trailers, and that you have $2,000 still open to suppliers that you need to pay, and therefore a total of $32,000 in overall liabilities. So as we think about our equity position, we take the $65,000 in assets that we have and we subtract out the $32,000 in liabilities. And it's going to tell us that we have $33,000 of available equity in our business. Now, when we say that our business is worth $33,000, this is what we would call the asset value or the cash value of the particular business. I want to make sure that you don't confuse this with like the market rate of what your business would be worth if you were to go to try and sell the business. A lot of times you'll hear people say like, oh, this is what your business is worth. And again, mathematically speaking, there's some validity there, but it's not actually the same thing as the market value or what we call the enterprise value of your business if you were to try and go and sell it on the open market. So looking at this balance sheet position, there's really three things that we're going to be able to identify. First and foremost is that we don't actually have a ton of cash on hand to support going out and being able to buy additional equipment or pay more folks without having more money coming into the business. The second thing is that we have a lot of our equity tied up in illiquid things like the value of our mowers and equipment and our trucks and things along those lines. And so there's not a lot of liquidity in our business due to the fact that it's all tied up in these assets. And speaking of those assets, we also still have a lot of debt and liabilities associated with those that, depending on our business credit and our debt to income ratios and things along those lines, may impact our ability to go out and get additional financing if we needed to do that in order to secure new equipment to service this new large account that we've picked up. So while these three factors may not entirely limit our ability to take on this account, it is still important to be able to keep that in check, to be able to understand what decisions that you are going to make. Do you have a line of credit that you can utilize instead of spending the last of the cash that you have available? Are you sitting on too much debt, and can you potentially go to the supplier and negotiate where they need to make a deposit up front so that you can buy some of the equipment that you need to in order to not create extra burden on your business? And so taking a look at your balance sheet is going to help you identify those things and maybe think about whether this is the right time to go into that new big relationship, or how you might be able to negotiate to get some better terms on the contract that benefit you from a financial perspective as well. And now the third financial statement that we're going to be talking about is our cash flow statement. The cash flow statement is kind of like the checkbook for our business, in that it shows all of the money that's actually going in and out of our business and where that's kind of coming from. So our cash flow statement is broken down into three different segments. The first is going to be operations. And under the section of operations, we're going to have cash coming in. And this is going to be cash coming in from revenues and sales that are happening to our clients. We're also going to have cash going out, and that's going to be for things like materials and for wages and other expenses that are associated with actually running the operations of our business. The next of the three segments of the cash flow statement is investment activities. So this is going to be where you would capture, for example, if you were selling off assets from your business, that would be represented by cash in. And then on the flip side, if you were buying assets for your business, that would be reflected in cash out. The third bucket of money coming into and out of your business is that's going to fall under financing activities. And this is basically money that's either coming from the owners and investors or from banks, right? So money coming in would be owners' contributions and loans, and money going out would be payments going back to those exact same sources. So why is this important? The cash flow statement is going to show you the actual flows of your cash, hence the name of the document, at any particular point in time. We've already kind of talked about the fact that our income statement can be shown on a cash or an accrual basis. There's also things that are going to be shown on our income statement that are what are called non-cash expenses. And we also capture everything on there regardless of what its source is. Likewise, our balance sheet is always going to show us a particular snapshot in time and not necessarily how things flow around. Being able to look at our cash flow statement and understand where cash is coming into and out of our business, specifically from our operations, as well as where cash is maybe coming in from other sources like financing activities, if you're leveraging a line of credit to offset shortfalls or to be able to make a large purchase, you're going to be able to see those ins and outs and be able to isolate where they're happening so that you can really be able to understand whether the operations of your business are profitable or have you been supplementing that by cash from other sources. Looking at your cash flow statement is really going to be helpful as you're thinking about planning for growth because growth eats cash. And so if you don't have healthy cash flows from your operations from a month-to-month perspective, that is going to put pause on your ability to figure out how you're going to grow. And while it may feel like you want to take on debt or additional investors, being able to understand what your burn rate might look like is going to be important. And a burn rate is a way of basically looking at, hey, with this increased cash coming in, the amount of investment that I'm going to have to make, usually in terms of marketing or hiring people, how long is that cash going to be able to stick around before I need to have new revenue coming in to offset it? And being able to see how those things play out is going to be really important. And that's something that you could model on your cash flow statement. And so let's take a look at our landscaping business again. And we've landed this nice $50,000 a year commercial contract. And we had previously looked at our balance sheet to see if we could make this decision, but we're also going to take a look at our cash flow statement in order to see if we've got enough cash coming in to support being able to deliver on this new contract. When we look at our balance sheet, we've identified that we've got quite a bit of assets, but as we've already said, we are heavy in fixed assets and people owing us money, which, while again, financially that's an asset, it's not necessarily always a good thing if you can't collect on that money. We also take a look at our income statement and we've identified that we've been generating great cash flow or great profitability, great net operating income on a monthly basis. And we think that we're going to be able to continue that by adding an additional $50,000 to our top line revenues. So when we go ahead and take a look at our cash flow statement and we look at cash from operations, we can see that we are averaging about $10,000 a month of cash coming in, but that we actually have $12,000 a month in cash going out, and therefore a deficit of $2,000 every single month that we would have to make up for in cash coming into our business in order to maintain long-term financial health. When we look at the investment line within our cash flow statement, what we see is that we recently spent $5,000 buying a new mower for our business. And so that took a chunk of our cash out of our bank account because we bought that with cash. Then we're also going to look at our financing line on our cash flow statement, and we see that we have $1,500 a month in loan payments for our trucks as well, still outstanding. And so as a conclusion, by taking a look at all of these different moving parts, what we're able to identify is that although this is a phenomenal $50,000 contract, because the way the contract terms are actually written out, you're only getting 20% of that upfront. And this $10,000 that you're going to get is not enough to cover the operations for the next 3 months because the rest of your contract is actually set up on net 90 days, which means you won't be paid up to 90 days after you have provided the service. And given that you have to get additional equipment and potentially bring on some temp labor to support this contract, it's just simply not going to be feasible for you to be able to float the cash to take on this new project. What that may mean is you may need to go back and negotiate either getting a larger deposit up front or shortening their net terms from 90 days down to something maybe closer to 30 or 45 days so that you can get cash coming into your business quick enough to pay out what your expenses are. Now that we've gone over the 3 main financial documents, we really want to take a deep dive into our income statement. And so I want you to click on this video over here where we can go dive deep into how you're actually going to read through that document to make those business decisions we talked about. I'll see you over there.